Hi, this is Alan House. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Sharif Abdu and Charlie Moran. We here at Value Line hope you and your family are staying safe and dealing with this difficult time as best as possible. Today we're going to provide an update on the COVID-19 situation and its ongoing impact on the economy and stock market. We will also discuss the actions Value Line is taking to help our subscribers navigate this still challenging time. We will then recommend one stock to buy right now, and finally, answer any questions you may have. Please note that this presentation will be available on our website. That's www.valueline.com and our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are here at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Value Line Investment Survey. The service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product line includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now let's discuss the coronavirus, the economy, and the stock market. This content was prepared by Value Line's economic staff. Wall Street has so far taken second quarter earnings season in stride. That does not imply that quarter results have been great or even satisfactory in some instances. The news, though, has probably not been as bad as feared, and the positive surprises have occasionally even brought investors back into some recently out-of-favor equities, for example, Netflix. The Federal Reserve remains aggressive on the monetary policy tightening front. Recently, the central bank raised the benchmark short-term interest rate by 0.75% at its July Federal Open Market Committee meeting. More restrictive monetary policies are starting to produce the slowdown in demand the Fed was hoping for in its battle to drive prices lower. Investors need not look any further than the cooling of the housing market. There, elevated financing costs, fueled by the aggressive rate hike environment and a limited supply of available homes, have made buying a home less affordable. Mortgage rates recently surged to a level not seen since late 2008. Hopes of a more hawkish Federal Reserve orchestrating a soft landing for the U.S. economy are fading. The inverted Treasury yield curve, which occurs when the rates on short-term notes exceed those of longer duration government debt, may be an indication that the economy is heading towards a recession. A period of stagflation, where slowing growth occurs at the same time inflation is high and unemployment is rising, can't be ruled out either. The recent uptick in initial weekly unemployment claims to an 8-month high, and more companies, including tech behemoth Apple, announcing workforce reductions, may be signs of some emerging weakness in the labor market. In conclusion, we don't think this is the time to throw caution into the wind. There is still a lot of uncertainty for investors, including geopolitical concerns overseas and the impact of the Federal Reserve aggressively tightening the monetary reins into a period of slowing economic growth. We recommend that investors keep a mixture of equities, bonds, and cash in their portfolios and still give greater attention to the stocks of higher quality companies with strong cash flows. I'll highlight the one in the commentary. We don't think that this is the time to throw caution to the wind. There is still a lot of uncertainty for investors, including geopolitical concerns overseas and the impact of the Federal Reserve aggressively tightening the monetary reins into a period of slowing economic growth. Overall, we believe that stocks should continue to be part of a well-diversified portfolio, though, as mentioned, some caution is currently warranted. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We note that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and its shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. Sharif will now show you how to access it. Once signed in, you head to the dashboard where Sharif should already be located. This is the main landing page for subscribers. Under the quick links, click on supplementary reports, please, Sharif. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stocks to improve liquidity over the last 2 years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Due to the changing structure of company balance sheet, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank, which is a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Certainly, particular industries and sectors will recover more quickly than others during and after this pandemic has run its course. Okay, now we're going to the introduction to the screener, one stock to buy right now. For lists, Sharif's going to go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. Okay, now we're going to get into the steps for screening. Since market conditions are fluid, especially now, and long-term visibility remains clouded, we are going to focus on equities with superior prospects in the short and intermediate terms. For this, we're going to start out by looking at timely stocks. First, we'll scroll down to the ranks and rating section of our screening criteria. The first screen we're applying is timeliness rank. We're looking for stocks that are timely. In other words, stocks that are ranked 1 or 2 for year-ahead relative price performance. Our system is based on 5 tiers of ranking stocks, with 1 being the best and 5 being the worst. There are roughly 5,700 stocks in our database. By applying the one screen, which Sharif's going to do now, we're already down to 398 stocks. So we've whittled that list substantially from 5,700 down to 398. Okay, so we're going to stay with kind of intermediate to near-term prospects. We're going to apply another filter. This time it's 18-month total return of at least 35%. So Sharif's going to go over to the company data section and click on the 18-month total return. While the timeless rank for the 6-12 months is for the 6 to 12 month horizons, we think it's a good idea to look at an intermediate time frame as well. By applying this screen for 35%, we've narrowed the list down further. We went from 398, now we're at 124. Okay, now, especially during this, somewhat tumultuous time we're in, I think it's a very good idea to look at the balance sheet. So we're going to, look at some balance sheet considerations. So scrolling back down to the rate and rating section, we're going to look at 2 closely related criteria. One focus on the quality of the stock, and the other focus on the financial position of the company. First, we're going to look at is the safety rank. There are loads of risk measures out there, and that Value Line offers. We're going to start with the time-tested safety rank. The safety rank measures the total risk of a stock and is arranged on an easy-to-use 1 to 5 scale, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. We're going to focus on those stocks ranked at least 3 for safety. These are the largest, more stable equities in our coverage universe in most instances. Following this screen, we have now cut our list down to 97 stocks. So from, well over 5,000, we're down to 97 stocks. Okay, so we're going to get an additional level of security. With the pandemic, loads of companies have reduced headcount over the last couple of years and taken on more debt. So, a lot of balance sheets have weakened some during the pandemic. Although it's already a factor for the calculation for safety, we're going to double down and include financial strength. Those grades range from C to A++ in 9 increments. We're going to go with companies that garner a financial strength score of B++ or better. We believe that this is another metric that is worthy of attention given the current economic climate. And, I think average financial strength is generally about B+ or so. So we're looking at companies with a better than average financial strength. And Sharif just did that screen. So now we've whittled it down to 38 candidates. Okay, we have a couple more screens we want to do to get it down to where we need to be. The next screen is for the 3 to 5 year sales growth in the top 10% of the overall market. We believe that looking at the top line through a long-term lens is prudent. Sharif's going to click on the growth section, and we're going to look at the 5-year sales growth. That's in the top 10% of, the overall market. And after that screen is done, we should be down. Yes, we're down to 9 names. So we went from 5,700 or so down to 9. Okay, so we're going to do one more screen, and that's for 5-year earnings growth in the top 10% of the overall market, which is obviously the bottom line. So Sharif's going to stay on the growth rates, and he's going to click on the 5-year share in the top 10%. And following that screen, we are down to 7 names. Okay, that's a much more manageable pool to do our pick from. Okay, so you can make a strong argument for any of the 7 remaining candidates. And investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now. And after consulting with a number of my senior analysts, we prefer and recommend Charter Communications, ticker CHTR. Before Sheree clicks on Charter, please note that screens can be saved and revisited by utilizing the Create Save Screen button at the top of the page, which Sharif just showed you. Now let's click on Charter and get some additional information from Value Line's digital report. Charter Communications, following the May 2016 acquisition of Time Warner Cable and Bright House Networks, is one of the nation's leading providers of broadband and cable TV services. As of 12/31/21, it had 30.1 million internet customers, 15.8 million paid TV subscribers, and 9.9 million voice customers. It also provides wireless services and sells local cable advertising. Okay, now we're going to take a look at the latest full-page report, which was just published back in June. As you can see in the statistical array, or the standard report that includes the financial data, Charter has performed well over the past couple of years, with new earnings gains that have exceeded the Value Line average. We look for the positive momentum to continue in 2022, as a new streaming partner ought to help shore up both top and bottom line results. Specifically, in late April, the nation's second largest cable service provider and industry peer Comcast announced the formation of a joint venture to develop and market a next-generation streaming platform for 4K high-definition smart televisions. The venture ought to better position the company against streaming platforms such as Roku and Amazon, and act as a sort of hedge against a continued decline in the traditional pay TV business. Taking a look at some quantitative metrics, the stock has solid marks across the board, including a safety rank of 2, a financial strength rating of B++, price stability of 85, and price growth persistence of 90. The issue is favorably ranked for timeliness, as we noted before, and its 18-month appreciation potential is 35%, which is solid relative to other equities under our coverage. All told, we think that Charter Communications is poised for strong results both this year and beyond, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few questions were submitted prior to the presentation. Now I'll hand it off to Sharif and Charlie. Thank you.
Hello, this is Charlie Moran. I'm a senior analyst at Value Line, and I'm ready to answer further questions that you have regarding our survey. I got an initial question from someone named Charles asking about the term good quality and what it refers to specifically. There is no strict definition of the term good quality. When you see reports citing good quality stocks, it's really a euphemism for a stock that's perceived to have a good balance sheet and a high safety rank typically. But again, there is no strict definition other than one that has a high financial strength rating. I also got a question coming in from, I believe, Stephen, talking about the debt to capital ratio and the best debt to capital ratio. As you can see, if you can point to it on the page, get that up, Sharif. If you go down, to the capital structure box, you can see that the debt to capital ratio is a relatively high level of 88%. And the reason for that is that the equity has gone down relatively sharply despite the earnings gains as the debt has risen in past years. Now, there's no optimal debt to capital ratio. It really depends on the industry, and I would caution in this case trying to compare with other media companies because they're really, in terms of cable providers, the only one that comes close is Comcast, and obviously they have an NBC Universal business that isn't analogous to what Charter does. So there's really no set level to use in judging the balance sheet and what the appropriate capital structure is. But if you look at it relative to historical levels, it can provide clues, and it can also give you a sense as to the ability to pay out dividends if the stock or the company is paying out some of their cash flows to subscribers or to stockholders. Excuse me. Let's see. Other questions. One was regarding the relative PE and the 0.99 level from Shirley. This is the relative PE at the top of the page is 0.99, and you can see that that is distinct from the PE ratio, which is 16.5. The PE ratio, again, is consistent. It consists of the earnings for the prior 6 months combined with the future 6 months, and that would be divided into the stock price to attain the PE multiple, which in this case is 16.5. Now, the relative PE ratio is 0.99 because it has, at a slight discount to the overall universe, the value line universe, which at this point in time I believe was 16.6. Let's see, just kind of scrolling down here for some more questions. Sharif, do you want to jump in with anything? Do you see anything in the Q&A? Got another question from Jack in reference to considering technicals and the fact that Charter is in a bit of a downtrend, a solid weekly downtrend from 800, and his question about why it would turn now. To get to technicals, we do have a technical ranking that you can see in the upper left-hand corner. I don't know if you can highlight that, Sharif. The technical ranking is 4. We don't divulge how we come up with that, but I will say that, in terms of considering technicals, as you mentioned, there are a lot of subjective factors typically in what is thought to be good or bad technicals in terms of chart formations, and this is something that is done on a quantitative basis, to my understanding. So that is all I can say with regard to technical ranking, but I think that there is a bit of a consideration to technical ranks. However, that's not going to come up in the timeliness rank or the safety rank other than the price growth persistence, which is in the bottom right-hand corner. Again, in terms of chart formations, again, that's subjective, and we're really not going to make a call on that. Paul has another question on how to forecast dividends. That, typically is going to be a function of their historical trends and also just management's comments on what they believe to be the appropriate capital structure going forward and their public comments on how they want to return cash to shareholders. There's really no other way to judge the dividend forecast. And also you look at the payout ratio, which is also on the bottom row of the array. If you see down there, I don't know if Sharif can get to that, but you can see an all dividends to net profits row, which in this case obviously is nothing because they don't pay a dividend. But typically there will be a percentage that some managements will try to maintain a specific ratio, and that will also factor into projecting future dividends. Let's see, I'm trying to scroll through all the questions here. There's a question from Steve, another Steve, asking about consumers moving to streaming services and the problems that Charter may encounter with that. Yes, that is potentially a problem, although with all stocks, our analysts have, I guess the best way to put it, the opportunity to project what they see in terms of the industry dynamics and how they're able to, deal with the competitive environment. I know that Charter put out another quarter in July that was somewhat disappointing, that caused the stock to go down, but it has quickly recouped a lot of the share price loss. But all cable guys are dealing with subscriber issues, although in looking at Charter's public comments, they mentioned that their churn is still quite low, and the pricing is still not so bad. So, you wonder about growth returning, but I think at this valuation, it's the analysts, excuse me, it's the analysts thought that the beaten down prospects or the beaten down issues are priced into the stock. Let's see. I'm just looking for some more questions and scrolling through.
Charlie, I saw one that caught my eye, if you don't mind. There was
Sure,
one about someone's interested in dividend-paying stocks, and they know that Charter is not dividend-paying. There are screens we can use to look for dividend-paying stocks. The current value line median, I believe, is 2%. So you can scroll for stocks, with a 2.5 yield or what have you. There's other metrics we can use to look for dividend-paying stocks. And we also have another product called the Dividend Income Growth, which also focuses on companies that have high dividend growth potential, going forward. So I just wanted that question caught my eye. I just wanted to, interject and answer that. Thank you.
Thank you. No, keep the questions coming. I'm just kind of trying to scroll through here and answer simultaneously. I got another good one from Randy, who asked about the thin black line, the cash flow per share on the chart at the top of the Charter stock report, and that is typically going to be there in the array of every stock that you see, except for those that may not have a long enough history for us to put in an appropriate cash flow line. But you can see, as Sharif kind of points at it right now, this is just a line that represents the cash flow per share each year, multiplied by a multiplier that's up in the left-hand corner. And we think that this is a better estimate of the true valuation of the stock rather than reported GAAP earnings that can fluctuate and be susceptible to earnings or accounting changes and accruals and the like, and that the cash flow provides a better estimate of the valuation of the company. So I hope that answers your questions, Randy. And then there was another one from Andrew recently about a chart for changes to PE. I don't know if you're referencing the PE for our universe, which is at the front of the survey that we put out every week, or if you're talking about the changes to the PE for every individual stock. But if it is the latter, you can see how the PE has fluctuated looking at the array, and you can see, go back historically to see the fluctuations or the changes to the PE in the array, the row that's average annual PE ratio. Thank you, Sharif, for highlighting that right there. You can see that, for instance, in 2016, it was 14.8. It was then very elevated or skewed in the subsequent years, but in 2020, it was 36.1 and then 28. So that can give you a good estimation of what the absolute PE is, and then the relative would be beneath it for its multiple relative to the entire market. I guess that's about it. That's all I'm seeing on the question front. Is there anything else that you guys see?
Yeah, I
Alan?
just had one final question. This one is from Ron. They were asking about what we screened for. I just want to go through that really quickly. It was a timeliness rank of 1 or 2, target price range midpoint of at least 35% for the 18 months, safety rank of at least 3, a financial strength of B double plus or better, and the last 2 were 5-year sales growth in the top 10% of the overall market and the 5-year earnings growth in the top % of the overall market. You can use as many or as few screens as you like. You can use 2 or you can use 10. It's all according to what you're looking for and what kind of granularity you're looking for. So with that, I think that concludes our presentation for today. I'll give it back to Brandon. Thank you all for joining.
And that concludes the presentation for today, and you may now disconnect your lines. Thank you.